Hi, everybody. I've had a lot of clients reaching out to me recently. They're concerned about the conflict with Iran and the effect that it's having on the financial markets. I'd like to share with you how I typically respond to clients who are concerned about major global events like this and the effect it might have on your investments and your long-term financial plan. I like to focus on what events like this mean for people who might be divorcing later in life, who may be near retirement, or indeed even in retirement. First, I'd like to deal with what lessons we can learn from past wars. Second, I'd like to focus on a concept called sequence of return risk and why this concept is important for people nearing or in retirement. And third, I'd like to look at the opportunities that market downturns can provide. If past wars have taught us anything, it's that the financial markets don't just react to the war itself, they react to what the war changes economically, especially the price of oil, the rate of inflation, and the direction of interest rates. What we're seeing in Iran right now fits this historical pattern to a T. The main financial risk with this conflict is the disruption in the supply of energy, causing gas and fuel prices to rise sharply. We've already seen this with the price of oil skyrocketing to over $100 a barrel over the course of the past few weeks. The effect of a prolonged oil shock would be that it contributes to keeping inflation high. And when inflation is high, that forces the Federal Reserve to keep interest rates higher for longer. And when interest rates are higher, that slows economic growth. It makes business costs more expensive and hurts company profits. It also puts a big damper on consumer spending as it raises the cost of borrowing. None of which is good for the stock market. There are a couple of key points about this conflict with Iran that concern many observers. First, Iran's location, specifically the passage of oil through the Straits of Hormuz, makes oil disruptions more impactful than many other conflicts. Secondly, the Federal Reserve in the US has been dealing with inflation over the past couple of years as a primary concern. Unlike some past wars where inflation was very low, the impact of supply disruptions is likely to be amplified given our focus on keeping inflation down. Third, and maybe to a lesser extent, is that the stock market is very sensitive to interest rates, and the value of many stocks depend on a favorable interest rate environment. If we look back over past conflicts, such as the war in Iraq or the Gulf War in 1990-91, or even Afghanistan back in the 1980s, we can see some similar trends. Before and right after these wars begin, the markets get nervous. Stocks often fall in the lead up to conflict due to uncertainty, and after hostilities begin, they continue to drop for a short period. However, markets are resilient, and the S&P 500, for instance, typically shows a gain in the order of 8 or 9% on average in the 12 months after the beginning of a major shock. The thing is that markets react to expectations, not just events. I'm recording this podcast on April 1st, 2026, and we've just seen two very strong days in the stock market as stocks have rallied on comments from the White House that the war might end soon. So while the headlines from the Middle East may be scary, the market is doing what it always does and reacting to a current future outlooks of a potential cessation of conflict. Now, of course, this recent recovery in the market could have completely reversed itself by the time you listen to this podcast. That will really depend on how investors are interpreting the outlook for the conflict. The real damage to your stock portfolios will ultimately be determined by how long oil prices stay elevated and how long this war continues. Longer-term downturns in the stock market are much more likely to be caused by economic events such as the stagflation we saw way back in the 70s and the Great Recession of 2008, 2009, than they are by military conflicts. For a younger investor, it's easier to ride out these bad spells in the market. If you're in your 30s or 40s during a downturn like the Great Recession of 08, 09, you've likely got 20 or 30 years to not only recover from that downturn, but for your investments to continue to grow for retirement. When you're saving for retirement in your 30s, 40s, or even 50s, you're in what's called the accumulation phase. You're looking to grow your investments, and you can afford to take a little more risk because you've got more time to ride out the market's ups and downs before you retire. But if you're in your 60s and 70s and retirement is just around the corner, or even already here, you're in what's called the distribution phase. Your portfolio needs to be oriented towards generating income for your expenses in retirement. If you're about to retire in your 60s, or if you're getting divorced in your 60s and your net worth has just been cut in half, time's not exactly on your side. When you're nearing or in retirement, you're usually withdrawing money from your investment portfolio, the distribution phase I just mentioned. And if the market drops early in this distribution phase, it can hurt much more than if the same drop were to happen maybe 10 years later. This is the concept of sequence of return risk. Sequence of return risk is the danger that the timing of your investment returns, not just the average return over time, could significantly impact how long your retirement savings last. Poor early returns can permanently damage a retirement portfolio, even if long-term averages look fine. Let's consider an example of two retirees who experience identical average returns over 20 years. Let's meet Jim, who gets bad returns in the early years of his retirement, then good returns later. And here we have Susan, who gets good returns early, then bad returns later in retirement. Even if their average return on their investments is identical over a 20-year period, Jim can run out of money much faster than Susan. This is called sequence of return risk. Let's look at what's happening to cause Jim to possibly run out of money. When markets fall early in retirement, you're forced to sell investments at lower prices to fund your living expenses. So your portfolio has money left to recover when the markets rebound. What happens is that losses get locked in. This is especially critical in the first 5 to 10 years of retirement. Let's look at Jim's portfolio, which starts with $1 million. And let's say he's withdrawing $50,000 a year. What happens if the market drops 20% in his first year of retirement? In year 2, Jim's withdrawing from a much smaller base. Even if the market recovers later, his portfolio may never catch up. So how can you reduce sequence risk in your investment portfolios? First, it's a good idea to keep a cash or bond buffer in your accounts. Hold 1 to 3 years of expenses in very safe assets. This way you can avoid selling stocks during a downturn. Similarly, by having a diversified portfolio of stocks, bonds, and some other assets, you reduce the overall volatility of your investments so they don't go down as much when the stock market hits a rough patch. Another strategy is to be flexible in your withdrawal rates from your investments. Consider reducing spending after bad market years. And if the market has a couple of good years, potentially you can up your spending again. Many times, when I'm working with my retired clients on their investment portfolios, we look at their expenses in relation to how much guaranteed income they have from sources such as Social Security, pensions, or annuities. The more you can rely on guaranteed sources of income, the less reliance you have on investments, and the less you're subject to the ups and downs of the stock market. While market downturns are uncomfortable, indeed, they're inevitable, they can also create some tremendous opportunities. The most obvious opportunity is that famous saying of the stock market to buy low and sell high. If you have a diversified portfolio of stocks, bonds, and cash-like investments like CDs or money market funds, and the market goes down, you can use some of that cash to purchase stocks while they're on sale. Market downturns also create some of the best tax planning opportunities you'll ever get. The key is to use losses, reposition assets, and prepare for future market recoveries. Tax loss harvesting is one of the tried and true tax strategies. When investments drop below what you paid for them, you can sell the investment at a loss. You can use that loss to offset other capital gains. And if those losses exceed gains, you can deduct up to $3,000 a year against ordinary income. You can also carry forward those extra losses indefinitely. Just remember, you can't harvest losses in retirement accounts like 401ks or IRAs. Losses there are not tax deductible. We're talking about taxable brokerage accounts here. You can also harvest gains strategically. If you're in a lower tax bracket during a downturn, you may qualify for a 0% long-term capital gains tax. This might give you the opportunity to sell appreciated assets and then rebuy them. What you're doing is you're resetting your cost basis at a higher level to put yourself in a better position for future sales. This strategy is called gain harvesting. One tax strategy I really like in markets that have suffered drops are Roth conversions. A downturn is one of the best times to convert a regular IRA to a Roth IRA. Just remember, you're paying taxes on the amount of that traditional IRA that you convert. The reason that this is a powerful strategy is that you're converting that traditional IRA when the account is depressed in value. When the inevitable market recovery happens, it happens tax-free inside the Roth IRA. This strategy pairs especially well when your income is temporarily lower for whatever reason, or when markets are down significantly. A moment ago, I mentioned the age-old strategy of buying low and selling high. This should be coordinated with a strategy of rebalancing your portfolio with tax awareness. Now, what does that mean? Well, when the market drops, it throws your investment portfolio out of alignment. If stocks fall sharply and bonds and cash don't, which is typical, stocks now represent a smaller portion of your overall portfolio. Rebalancing is simply using some of your cash available to buy stocks at this lower value to bring your account back into your original preferred risk level or alignment. You might consider doing this rebalancing inside tax-advantaged accounts first, like IRAs, to avoid triggering taxes. In taxable accounts, it's a good policy to try to rebalance using new contributions or dividends or money market funds. Another good strategy during market downturns is to double down on contributions. When prices fall, you should try to increase your contributions to retirement accounts. You're essentially buying assets on sale. If your 401k has an employer match, make that a priority. You may also want to put more into your traditional or Roth IRA, depending on your tax situation. Finally, downturns are a good time to rethink what type of accounts you hold your assets. Bonds or real estate investment trusts, what we consider tax-inefficient assets, taxed at ordinary income tax rates. Keep these in tax-deferred accounts like retirement accounts whenever you can. If you're going through divorce in your 50s and 60s, if you're approaching retirement and you're nervous about the stock market, I'd be happy to chat with you. Free, no obligation. Me and my team can look at your unique situation and help you build a strong financial foundation for a meaningful and purposeful life after divorce. Until next time, take care.
Thanks so much for tuning in to this episode of the Grey Divorce Podcast. To learn more or get in contact with your host, you can visit Andrew's website at transcendretirement.net. Also, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. That helps others find the show, and we greatly appreciate it. Thanks again for listening. And and we'll catch you in the next episode.
Information provided is educational only and should not be construed as legal or tax advice. Each situation is unique and should be discussed with your tax or legal advisor prior to implementation. Andrew Hatherley is not an attorney and does not provide legal advice. Information provided is financial in nature. Advisory services offered through Hatherley Capital Management, LLC. Divorce financial analysis services offered through Wiser Divorce Solutions, an affiliated company.